LiteFinance, the world of financial freedom.
Good morning, it's Monday, March 28th. Let's start market forecast. So, we will talk about the most important events for this week, i.e. the current situation on the oil market and the hawkish Fed, which caused panic among analysts and caused a lot of discussion. So, okay, let's start with oil because we are receiving information about lockdowns in Shanghai, which are to last 9 days. So, despite the scares and panic sown by journalists, this should not have any major impact on the demand. You can be more afraid of the lack of Russian oil on the market. However, and here the situation look under control as well, because the International Energy Agency has already announced that it has enough reserves to intervene in the market again, which is really the reason why it was established in the first place, which is to defend price stability in the market. This month, 30 million barrels have been already released to the market from strategic reserves, and about 60 million in total. The agency itself announced that they have a supply of 1.5 billion barrels, so we should rather not expect a sudden jump, and when the price starts to rise, there is a hedge buffer. So this can be seen even in the markets where, despite the attack on the branches in Saudi Arabia and their statement that they cannot be blamed for price instability due to forces beyond their control, the oil price remained in the range of $110 on WTI and $115 to $118 on Brent. Another issue is the number of rigs, which is constantly increasing, so the supply is increasing constantly as well. Then the conflict in Ukraine is clearly not going according to Putin's plan. The Chinese probably do not support him as much as he expected, because China still needs good relations with the West at this stage. Gazprom continues to supply gas via Ukraine to Europe, so it is clear that they do not want to escalate more, at least for now. And that didn't stop President Biden a bit, who decided that it was a good time to play in Putin's game a bit with a statement about the change of power in the Kremlin. Therefore, US officials had to step in and ease the situation. So somewhere this situation begins to stabilize, in quotation marks. It can fade away, but it's hard to put it differently in the face of the horror that is happening in Ukraine. But unfortunately, this is the reality. Now let's move on to concerns about interest rate hikes. Previously, I discussed the rises and Powell's comments at a press conference, but everyone seems to be more hawkish than the head of the Fed himself. In fact, Powell left such a possibility, I mean the 50 basis point rate hike, but so far there is no indication that it will happen, and even the super good data from the labor market on Friday should not affect it. Powell himself knows well and made it clear during his statement that interest rates do not have such a large impact on the current inflation, and that for the real effect of increase, we will have to wait to see. So how can they suddenly probe a 50 basis point rate hike, since they don't know what the effect they actually have? Will a rate hike suddenly increase oil or gas production? No, but unfortunately, this is what the media message looks like. As for the largest companies with the highest market share, they have a huge cash reserves. In addition, the interest rates on loans are fixed, so their installments will not increase. Only future liabilities will be more expensive to service. In addition, even if it raises interest rates over time to 3 or 4%, global companies can incur liabilities where they are comfortable, where they have the most favorable conditions. Another issue is the profits of companies that are constantly growing. The business sentiment is strong, above 55 points, which also proves that we are currently dealing with a correction. And this is also the answer to concerns about inflation. Companies maintain high margins, profits are growing above expectations, and consumers have no problems with consuming despite rising prices. So it is probably not that bad after all. So moving on, this week we will receive a lot of important data, such as US GDP on Wednesday, on Thursday Great Britain and Canada GDP, on Friday manufacturing PMI from Germany, the UK and US, and the cherry on top will be CPI inflation from the Eurozone. In addition, you have to remember about Thursday's OPEC meeting and their decision to increase the monthly output, which should not be surprising for the markets, but now, more than before, at such a sensitive moment, you need to follow what comments will be made during the meeting. So okay, now let's go to the charts. As far as the oil market is concerned, while we are in the zone between $115 and $120, I must say I am neutral. I will wait for the breakouts from this zone and possible retests of support and or resistances, and additional confirmation to enter the position one way or the other, with targets for $105 or $130. So gold in turn at the level of 1920 or 1925 has a strong support zone. In addition, we have a cluster of FIBO measurements, and namely twice the 61.8 levels, measured from the higher time frame, and the current upward movement started 2 weeks ago. So if we break this level, I would look for a short entry with a goal of 1880. It would be best if it happened by Thursday before the NFP. I would like to see the dollar strengthening on the wave of good US GDP data, which should help weaken the gold. If we do not beat this support, we will have to look for a place for long trades. At the end, euro dollar. As I mentioned here, during the first days, I would expect the dollar to strengthen and retest the zone around 1.0900, and only a continuation of the move to the north at the end of the week after the PMI data from Germany. So that would be all. Thank you for watching, and goodbye, guys.